I want you to pay close attention to what happens in your brain when you open your phone. A few weeks ago, Goldman Sachs, one of the most powerful investment banks on the planet, released their densest financial outlook report of the decade. A document spanning over 100 pages containing deep analysis, complex charts, and mathematical projections for the American economy in 2026 and the years to follow. Within minutes, not hours, minutes, an invisible machine sprang into action. News portal headlines started flashing in dark red. Goldman Sachs predicts market crash. Immediately, the army of financial influencers on YouTube and TikTok activated their cameras. They uploaded videos with thumbnails showing terrified faces, red arrows pointing into the abyss, and titles like, "Buckle up, the 2026 crash is here." Panic spread through the comment sections like a wildfire in a dry forest. Ordinary people began contemplating liquidating their retirement accounts out of pure terror. There's just one colossal problem with all this hysteria. That is not what the report says. Not even close. I spent the past week locked down, dissecting every single page, every footnote, and every chart of this financial intelligence document. I cross-referenced their data with macroeconomic reality, separating what Goldman Sachs actually calculated from what click-driven content creators want you to believe. And what I found in the trenches of that report is infinitely more nuanced, much more dangerous for amateurs, and vastly more useful for us than the doomsday crowd wants to admit. The naked truth is this: Goldman Sachs is not predicting a cinematic crash for 2026. They are predicting something that, ironically, is much harder for the average human mind to process and endure. They are outlining a scenario that requires a completely different operational playbook than the one that made people rich over the past 15 years. I am Buck, and today I'm going to be your tactical translator. We are going to pierce through the fog of the media war. I'm going to show you exactly what the American report reveals. I will expose the 4 lethal risks they identified that the media ignored because they don't generate easy clicks. And most importantly, I'm going to hand you the positioning doctrine for your money in 2026 and the decade ahead. Straighten your posture. Class is in session. Let's start by clearing the smoke. What does the official document actually say about the market in 2026? Goldman Sachs titled their flagship report with a very specific phrase: U.S. resilience. Just stop and think about the semantics of that choice. That is not the title of a doomsday manifesto. It is the title of a document arguing that, despite operating in a minefield of global risks, the American economy and stock market have proven formidably durable. Their core, absolute projection for the S&P 500 index in 2026 is a positive return of 7%. It's not a crater. It's not stagnation. It is a solid, steady gain of 7%. How does the bank's intelligence arrive at that number? The behind-the-scenes math is what separates professionals from victims. Goldman projects that corporate earnings growth added to dividend yields will generate a gross gain of 11%. Companies are still raking in brutal profits. The trillion-dollar artificial intelligence infrastructure build-out continues to move the real economy. The consumer continues to spend. The business fundamentals are operating at full force. But if fundamentals grow by 11%, why is the final projected return only 7%? Because Goldman applies a gravitational force called valuation compression, or multiple contraction. They subtract 4 percentage points from the equation. Why? Because stocks are expensive today. They are trading at an optimism premium. The bank calculates that a portion of that initial enthusiasm will evaporate in 2026. Prices will adjust closer to reality, while real earnings rise to justify those prices. 11% real growth minus 4% price adjustment equals a 7% net return. A 7% return is slightly below the explosive historical average we have grown accustomed to seeing, but it remains a formidable growth rate. It is not the absurd 20% surge we've seen in recent years, but it is light years away from the collapse the headlines tried to sell you. Furthermore, they quantified the risk of recession at roughly 25%. In probability terms, that means there is a 75% chance of continued economic expansion. Is there danger on the horizon? Yes. But it is not the end of the world. So why did the entire internet scream that the sky was falling? Because they conflated the data with a different report, released months earlier, that made a 10-year forecast. In it, Goldman projected that the next decade might deliver average returns of only 3% annually for the S&P 500. The media seized the 3% number and weaponized it into panic. What they forgot to mention is that the bank's forecast for global equities was nearly 8%. Furthermore, Goldman explicitly stated in the text itself that low forward returns do not mean an imminent crash. The market can remain expensive for years and still print money. The transition from an expensive market to a fair market does not require a 40% free fall. It can happen through a long, dragged-out period of modest gains, what I call the desert of boredom, where corporate earnings slowly catch up to the inflated stock prices. This doesn't destroy investors. It merely tests their patience to the absolute limit. We do not ignore threats. We analyze them coldly. And Goldman's report points to risks that are very real, but which the average investor fundamentally misunderstands. First, the pricing concern. The CAPE ratio, cyclically adjusted price to earnings, created by Nobel laureate Robert Shiller, is hovering around 39 to 40 times earnings. To put that in tactical perspective, the 150-year historical average is roughly 17. We are operating at more than double the long-term average. The only other time in history this indicator crossed the 40 line was in the year 2000 at the peak of the dot-com bubble. When the civilian investor reads this, their heart stops. The 2000 bubble decimated portfolios and took 13 years to recover from peak to peak. But deep tactical analysis argues that this comparison is lazy. The anatomy of the market has mutated. Today's largest companies are not zero-revenue websites selling hope. They are the most efficient, brutal, and dominant cash flow machines in the history of capitalism. Profit margins have undergone a structural shift. Today's tech behemoths require fewer physical factories and produce massive margins, which partly justifies a higher price multiple. The price is high, but the quality of the asset is too. The real danger. The Achilles heel that Goldman identified and that should put you on high alert is not the price. It is concentration. Currently, the top 10 stocks in the S&P 500 represent over 40% of the entire index. This is the most extreme level of concentration in recorded market history, surpassing even the worst bubbles of the past. Think about the physics of that. If you are a civilian investor and you put your money in an S&P 500 index fund thinking you are broadly diversified, the reality is that 40 cents of every dollar is lashed to the fate of just 10 corporations. The other 490 companies split the crumbs of the remaining 60 cents. A single company, NVIDIA, represents nearly 7% of the entire market alone. The strategic concern isn't that these companies are bad. They are spectacular. The concern is structural fragility. When an entire index depends on a half dozen companies, your retirement performance stops reflecting the broader American economy and becomes hostage to specific quarterly earnings reports. Imagine a giant cargo ship. If 40% of the weight is concentrated on a single point at the bow, the ship might sail fast in calm waters. But if a specific wave hits that exact side, the ship capsizes. If the massive investments in artificial intelligence do not yield the promised profits in the coming years, a shift in sentiment regarding this tiny cluster of companies will make the entire market bleed violently, even if the bakeries, banks, and factories across the country remain perfectly healthy. Concentration does not cause a crash on its own, but it acts as an amplifier. It makes any movement, up or down, absurdly more violent. Beyond concentration, the report exposes 3 phantom enemies. These are macroeconomic threats that won't destroy the market tomorrow morning, but they act as a constant fog on the battlefield. Enemy 1. The sovereign debt Leviathan. The ratio between American debt and gross domestic product continues to climb with no breaks in sight. The bank lists the obvious cures: tax hikes, deep cuts in government spending, or drastic entitlement reforms. But they admit the cold truth: there is zero political will to execute any of these cures. The rising debt is a shadow tax. The government must issue more bonds and pay higher interest to roll over this debt. This competes directly with money that would flow into the corporate sector. There will come a tipping point where the global market demands higher premiums to swallow U.S. debt risk. Goldman isn't predicting an imminent default crisis, but they flag the debt as a perpetual background risk, a powder keg waiting for a spark. Enemy 2. The Chinese logistical chokehold. Most people only discuss China in terms of tariffs or military tension. Goldman points to the supply lines. China controls nearly 70% of rare earth mining, 92% of refining, and almost 95% of global magnet production. These aren't just rocks, they're the lungs of modern electronics, electric vehicles, and Western defense systems. Furthermore, the global pharmaceutical industry relies heavily on Chinese chemical precursors. This creates a chokehold. Over-reliance on a geopolitical rival is a logistical vulnerability that can trigger colossal inflationary shocks if trade routes are suddenly frozen. Enemy 3. Monetary policy. Schizophrenia. The Federal Reserve and other central banks around the world are operating in a mixed monetary environment. Some signal cuts, others hold rates steady. Why does this matter to you? Because the current generation of investors has been spoiled. They've been trained like Pavlovian dogs to believe that whenever the market drops, the central bank will rush in, slash interest rates to zero, and save the market. The infamous Fed put. The report warns, if growth decelerates, but inflation stubbornly remains high, the central bank will have its hands tied. They won't be able to cut rates to save your stock portfolio without blowing up the price of food at the grocery store. Uncertainty destroys the confidence of amateurs. Now we reach the most valuable section of the entire intelligence compendium. The investment philosophy of the research team. What shocks people about the most brilliant minds on Wall Street is how unbearably boring their tactics actually are. They don't recommend elaborate, get-rich-quick schemes. They recommend 5 pillars: history as a guide, appropriate diversification, value orientation, unshakable time horizon, and robotic consistency. They attached a chart that should be framed on every investor's wall. It illustrates the cost of desertion. If you remained passively invested in the U.S. market from 2009 to today, your annualized return was nearly 17%. But if you tried to be smart, tried to time the drops, and ended up missing just the 10 best trading days over all those years, your return plummeted to 12%. If you missed the 25 best days of the entire decade, your return was sliced in half. Here's the lethal psychological detail. The best days in the market, the ones that generate the most explosive rallies, historically occur exactly and immediately after the days of the steepest declines. They happen when volatility is peaking and blood is running in the streets. The emotional investor who panicked during the 2020 collapse and hit the sell button committed desertion in the crossfire. They missed the massive rallies that followed within days. The man who tried to guess the bottom in 2022 was left behind when the recovery train departed. The implicit message from the world's top analysts is crystal clear. Trying to time market disasters destroys more wealth than the disasters themselves. The cost of getting the timing wrong is astronomically higher than the cost of strapping on a helmet and simply marching through the volatility. Goldman Sachs, with all its computational might, confesses that 5 years ago they could not have predicted a pandemic, a war in Ukraine, a 40-year inflation spike, or the sudden rise of artificial intelligence. The short-term future is, by definition, unpredictable and dark. No one owns a crystal ball. What they do know is that regardless of short-term chaos, the monotonous, robotic, and disciplined act of keeping your capital rooted in productive global assets is the only proven wealth generation machine in human history. How do we translate this raw intelligence into action for tomorrow morning? The protocol depends on your line of sight. If your theater of war is 20 years or more, the order is to ignore the noise. Close your ears to panicking influencers. Accept that the next decade may deliver more modest growth than the last, but hold the line. Consider expanding your diversification beyond large-cap U.S. tech. Look into international markets or equal weight indices to mitigate concentration risk. If you're 5 to 7 years away from concluding your labor operations, the concentration in 10 index companies is a severe tactical threat to you. You do not have time on your side to wait out a recovery from a tech sector shock. You must audit your base, rebalance your troops, and anchor your wealth on more diversified ground. Financial content creators operate in a perverse ecosystem. Panic generates clicks. Clicks generate ad revenue. Telling you the market will grow a solid 7% does not pay their bills. Announcing imminent catastrophe lines their pockets, while emptying yours by tricking you into selling at the worst possible moment. Do not make logistical decisions for your life based on headlines manufactured to scare you. Go to the primary sources. Read the cold intelligence. The market has severe risks, yes. The debt is real, the valuation is stretched. But they are terrain obstacles, not apocalyptic cliffs. Feeling informed today is useless if you do not have a rigid system to operate with tomorrow morning. If you consume information, but your financial structure still relies on chance, the emotion of the moment, and luck, you are an easy target. You need an operational map, an execution doctrine that makes your finances impenetrable to the media and unshakable in the face of crises. And that is exactly why we built the definitive survival tool. I call it the Order of the Day, 365 high-impact actions for your financial sovereignty. This is not a self-help book filled with motivational quotes. It is your war manual, detailing one command per day for an entire year. It will teach you how to build your tactical boredom doctrine, automating your capital so you are never again tempted to sell your assets because of an alarmist video. It will outline the exact protocols to audit your risk exposure, diversify your deployments, and build an impenetrable wall between your mind and the noise of the financial media. It will ensure you construct your optionality fund in a mathematical and cold manner, step by step, action by action. Access to the Order of the Day manual is unlocked right now. The official enlistment link is positioned right down below in the description of this video and in the first pinned comment. The financial investment you make in this manual doesn't come close to what you will lose making a single rash decision on a bloody market day. What it gives back to you is mental clarity and the sovereignty of your own empire. Let the crowd panic over the headlines. Let the amateurs flee the market. You will take tactical control, hold the line, and profit from their terror. The link is waiting for you. Keep your strategy cold, your portfolio armored, and your mind free. I am Buck, and I will see you on the battlefield.